There's a lot of chatter recently in the media about loan level pricing adjustments, also known as LLPAs, that went into effect May 1st. You know, I'm not a big fan of the media. They take topics, politicize them for their own needs. So I wanted to give you the facts and a few things that are not being covered in the media. LLPAs have been around for years. It seems that every year or two, some adjustments are made, and these adjustments are adjustments to pricing or the cost a borrower has to pay based on the risk of the loan. So as long as I can remember, a borrower with a lower credit score would have to pay a higher rate or fees than someone with a higher credit score. This is for conventional loans. A borrower with a 3% down payment would have to pay a higher rate than someone with a 40% down payment. All that makes sense. Those lower down payment loans, lower credit score loans have higher risk, and so banks build in extra pricing into those loans to hedge against that risk. So this all still remains true. I even saw a headline recently that said you should actually on purpose reduce your credit score, make late payments so that you can get a better deal on the mortgage. Please do not believe that clickbait. What has changed is that the adjustments have been reduced in some combinations of down payment and credit score, and have actually gone up in a few of the segments. A few adjustments, especially for higher credit score borrowers, went higher, got worse. And I agree, that's unfair. This is something we're actually just signed a petition for our congressman to relook at this because it is unfair. That being said, the adjustments, especially for the high credit score borrowers, are so small that they would not even affect the interest rate. So that's being over dramatized in the media. There are positives too. For example, a borrower with a 780 credit score putting down 3% will actually have a lower interest rate than they would have before these adjustments went into place. A borrower with a 640 credit score putting down 3% will have a much better interest rate than they would have in the past due to these changes, but still a significantly higher interest rate and fees than someone with a 780 credit score. Important things to remember that there are more credit score tiers. Now there's a 780 tier, a 760 tier, where in the past 740 was the highest tier. So that's important. And the adjustments, again, for those super high credit score borrowers are less than they were before, so they are getting a better deal. Most banks have had these adjustments built into their rate sheets as early as March. So anyone who's closing now, there's nothing really dramatically that has changed. That May 1st deadline is just for when banks sell the loans to Fannie Mae and Freddie Mac. And so in preparation for that, again, most banks have had all these adjustments in place already for months. At the same time, FHA has reduced their mortgage insurance, and we're seeing more and more borrowers where an FHA loan actually makes the most sense for them. And then I promised I would tell you something that's not being discussed. At the same time, if you have income of less than $140,000 in the Denver metro area, and you or one of you, if you're buying a home with somebody else, is a first-time home buyer, all these loan level pricing adjustments are actually waived. Okay, so to be a first-time home buyer, you are someone who has not owned a home in the past 3 years. And again, I'm helping a couple right now where he owns a home. They're going to rent it out. She does not own the home. They're buying the new house together, so they qualify. By removing all the loan level pricing adjustments for first-time home buyers, they are actually able to get dramatically better interest rates than they would have before this new law went into effect. If you have any questions, feel free to reach out. Have a great rest of your day. Bye-bye.